One of the reasons why we love looking at the synthetic indices is because of its volatility. And the volatility of synthetic indices makes it very easy to trade using price action strategies and technical strategies, such as you can use technical analysis such as ICT, CRT, whichever technical analysis or tools you choose to use. Even you can as well use technical indicators to trade. Now, the volatility is in the form of when it's time to move up, like this one. You see price just moving upwards, as you can see right there. You can see that was a very strong bullish move, and when price decides to move downwards, it moves downwards with strong momentum like that. And once in a while you get arranging price action like this, but in most cases when you decide to trade with a trend, when it's time to move downwards, you can see this one was a very strong bearish move, a short reversal here, shallow downward trend, and you can see this happens almost all the time. It is either you have a strong bullish move or a strong bearish move, or even if it is a downtrend or an uptrend, even if it is shallow, it's still moving up or down. So it makes it very easy to trade even using things like technical indicators. And one of the strategies or the technical analysis you are going to use today is you're combining the relative strength index and one price action pattern called the engulfing pattern or the engulfing candle. So I'll try and make this video as short as possible. Now these are synthetic indices and they are not available on every broker. The broker I use is Deriv, and if you wish to try them out, feel free to use the link below to open an account with Deriv and trade synthetic indices. Now, so what is an engulfing candle? I'll start there. An engulfing candle is a candle that closes above or below the opening price of the previous candle. For example, when you have the previous candle as a bearish candle like this, changes this to red so that it becomes a bearish candle, and then you have the next candle opening right here and closing as a bullish candle like this, but you find that that bullish candle is closing above the opening price. Let me change this color as well. Yeah, something like that. So we have a bearish candle and then a bullish candle. This bullish candle closes above the opening price of that previous bearish candle, and for now this becomes a bullish engulfing pattern. I can just write that down so that we can get it. Where's the text tool? Bullish engulfing pattern, like that, right? So once you have this bullish engulfing pattern, this is a sign that price is likely to reverse and change direction to the upwards. And you can see an example, a typical example is here. We have this opening price of a previous bearish candle, and then the next bullish candle closes above it, and you have price rushing upwards from there. Now the next thing is to show you a bearish engulfing pattern is just the opposite of this bullish engulfing pattern. A bearish engulfing pattern is when you have a bearish candle closing below the opening price of a previous bullish candle. You have that bullish candle, and then the next candle, which is now bearish, like that, and you have now the current bearish candle closing below the opening price of the previous bullish candle, and that is now how you know that price is going to change from, where's this thing, where's this, the this tool, where's this tool, where's this tool, it should be, is it here? Oh my goodness, wow, I think it should be here. Yes, path. So you have a previous bullish, and then you have this bearish engulfing pattern, and that signifies that price is now going to go lower, like that. Now, one of the things you have to realize with engulfing patterns is when you go to the lower time frames, assuming this is the higher time frame, when you go to the lower time frame, this just becomes a market structure shift in the lower time frame, or a break of structure, not really, but a market structure shift or a change in state of delivery. And if you trade ICT or smart money concepts or whichever other technical analysis, you'll know that change in state of delivery is a signal that price is going to change direction. Yes, so that is a quick overview of what bullish or bearish engulfing pattern involves. Now let us introduce a technical indicator called the relative strength index, like that, and we are going to use this to trade an asset called step index, which is a synthetic index only found on Deriv, in Deriv broker. Now let us look at an example of how we can combine both the relative strength index and these engulfing patterns. And the first example you can use is just this one here. You can see that price is significantly trading lower on the lower side of this relative strength index. I can pull it up so that you can see, and then we have price coming into the oversold zone of this relative strength index right at this spot here, and after that, while price is there, you have a bullish engulfing pattern or candle right here. Immediately after the formation of this bullish engulfing pattern, you want to take an entry there and target a risk to reward ratio of 1 to 3 or 1 to 4, and this is how you would have taken this trade right here. Now, am I saying this is the perfect strategy to trade? No, sometimes you'll encounter losses because losses are a part of the game. So let us look at another example where we have price in the overbought zone, and then it gives you a bearish engulfing candle or pattern. Let me look at this right here. Do we have a bearish engulfing pattern? This is the overbought zone. We do not have a bearish engulfing pattern. Can try and get another one. We only take trades when the price is now in the oversold or overbought zone after the formation of an engulfing pattern, or whichever whichever pattern, whichever direction. It can be a bullish engulfing pattern or a bearish engulfing pattern. And looking, you see now you have these oversold zones, and the typical way of trading RSI is to buy here, but now you can see there's no bullish engulfing candle, and that is how maybe somebody took a loss there. Another oversold, no engulfing pattern. Oversold, a very tiny engulfing pattern, not convincing enough. Oversold, this is not a typical oversold, but in the next video I'll talk about divergence, how you can leverage on divergence like that, and then you have a bullish engulfing pattern, and that would have been a trade, but that is for another video. Let us look at this overbought zone. You can see it's an overbought, but there's no bearish engulfing pattern. So these engulfing patterns, they just filter where you take trades and where you don't take trades, and that is why it becomes a very high probability or high a better way of filtering the trades you can take using RSI. And this works really well on synthetic indices such as the volatility 75 step index, volatility 25. I've seen it work well on the volatility 25 as well, and also the boom and crash indices. Now let us look at this oversold, and then we have a bullish engulfing pattern. Let us see if it worked. So this was the pattern. Immediately it closed. You want to take a trade, buy trade right there, stop loss just below this engulfing pattern, and you want to take maybe a risk to reward ratio of 3 or 4. Let us see if it goes to 4. You can see this one got to 4, and you can see after that price will continue to going lower, and probably you will have taken a loss if you had targeted a higher risk to reward ratio. Another example is here. You have a bullish engulfing pattern and then a very massive a bullish engulfing pattern after price has tapped into the oversold zone, and you can see you take a trade there after the close of that candle, stop loss below that, and take a risk to reward ratio of 4. And now this just goes to show you that not all the setups you get will be rewarding setups. Sometimes you'll hit losses. However, as I have said, if you leverage on something we call RSI divergence, this would have been a setup to buy, right? So this is a very high probability setups that you get after formation of divergence. Let us look at another example. I'm trying to get overbought zones, but I'm not finding one. So yeah, maybe you can use another time frame. Remove 9 drawings. Let's look at the 15-minute time frame, and this works on most time frames. This works on almost all the time frames. You can use it to scalp the 1-minute time frame. You can use it to take swing trades in the 4-hour time frame, the 8-hour time frame, or even the daily time frame. Let's look at the overbought examples. This was overbought. There's no bearish engulfing. You can see you have a bearish engulfing here. Price moved shortly lower but returned to get to another level to take out these stop losses or these highs. Let me try that right there. So you would have wanted a risk to reward ratio of 4, but this one it took you out. Let us look if we have another overbought level. Nothing. Can see this one here. This was a very big engulfing candle. Nothing. So you see the way using engulfing patterns filters the trades you can take using the relative strength index. This was a very strong engulfing pattern but did not move well. This one was a good one. %. Let us see if 50% would have worked. Stop loss there and risk to reward ratio of 4R. Did it get to 4? Nope, did not. So that was a good 3R but not 4R. This was a very good buy. Oversold engulfing pattern, you buy. Oversold engulfing pattern, you buy. But this would have been a loss, and then you look for divergence like that. So this is how you can utilize the engulfing patterns to take trades that are high probability using the relative strength index. Yes, so bearish engulfing pattern, overbought, you take that and get a risk reward ratio of 3R or 4R. Let's see if we got that. Stop loss just above that, and 4R, you get your 4R like that. So these are high probability setups you can take using the relative strength index and engulfing patterns. The relative strength index gives you a level where you can take trades, and the engulfing patterns filter the trades you can take and the ones you cannot take. This is also a good one. You can see engulfing pattern in the overbought zone, you take a sell there. So this is a repeatable system that you can take, and one of the things I love about this is it's very mechanical, a very mechanical strategy that you can use to trade something like even prop firms or even small accounts to grow them to larger accounts. So this is just one way of trading. I think I'll just one way of trading engulfing patterns with relative strength index. In the next video, I want to talk about how you can use RSI divergence with engulfing patterns to take the highest probability trades you'll ever get trading synthetic indices. Yeah, so till next time, bye bye.